Yes? Boom. I I think that's working. Think so. Live, live, live. Oh, I see you coming in. Yeah. Got you. I love it. I love it. I love it. I see you coming through here. This is awesome, guys. This is awesome. Let me know if you can hear me. I see your comments here. Let me know if you can hear me. I've got you coming in from YouTube. I've got you coming in from Instagram. I've got you coming in from Periscope, Twitter. Nice. All right. I love it. Perfect. Boom, 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 boom. Okay, guys, I'm a tinkerer. What can I say? Sorry. I like to tinker. I like to explore just different ways that I can stay connected with you and communicate with you. This is the era to do that in, you know? So, wow. Nice, guys. I've got all of you here in one place. It's becoming more and more challenging for me, right? It's becoming more and more challenging for me to be here and be there. And, I've got the YouTube live I want to do. I've got the Instagram live I want to pick up on. I've obviously been doing lives on Periscope for years. And then there are other things like I want to bring in. I want to bring in Twitch. I want to bring in TikTok live sessions now, which are available. So if there's a way for me to just basically get in front of you all simultaneously at the same time, whoo, that's the way to do it. That's the way to do it. So guys, just really doing a test here. And I hope you bear with me with these things. I hope I'm not bothering you. I promise that I'm testing for a reason. And I plan on really taking things that I have here to a new level of realization. So just working on some things, getting prepared for you. Really excited about this new chapter. I don't know how many of you are aware of this, but starting mid to late September, right into the end of the year for my industry, for my business, is the biggest part of the entire year. So in many respects, this is what people who are in my industry, this period of time is really what they have, I guess, prepared for throughout the beginning part of the year. It is basically to realize this. Even when I was trading on Wall Street, we traded every single day, every single week for profitability. But a big driver of our motivation at that time was really to hit certain bonus levels, right? So while every day and every week had an importance, the greater importance was making sure you did not blow up, making sure you steadily moved toward the best part of the year and you found yourself in good stead. So starting late September into October, then October into the end of the year is when my business really starts revving on all pistons. The engines are all go. So that's the case from a trading perspective. That's the case from a general financial industry perspective. And that's pretty much the case for all of my businesses, which are connected with trading as well. The last 3 months out of the year or so, that last quarter or so is the biggest and the busiest. It's the most demanding. So it's really interesting, and we find ourselves in that period of time now. Something else a lot of people don't understand. I want to give you some stats and statistics just before I close this test, right? A lot of people ask me, Oliver, what's the best time to trade? Well, the answer to that depends on what's your style of market play. The answer to what's the best time depends in large part whether you are a short-term oriented day trader, whether you are more of a long-term core trader to investor. But let me give you some stats. If you are looking at the market from a macro perspective, right? If you're looking from a macro perspective, you have statistically September is the worst month of the year. Statistically speaking. Now, my traders have known this for years because I believe in the repetitive cycles of the market. And so while nothing is 100% and nothing can occur consistently every single year, most years throughout financial history, the September is a rough year. Actually, August into September is a rough part of the year, the roughest part of the year, the roughest month, if you will. That's certainly been the case this year, okay? What's interesting is that October actually gets the bad rap for being one of the worst months of the year because such a huge concentration or a huge percentage of the market's crashes have occurred in October, or at least the notorious ones have occurred in October. So, a lot of your Black Mondays, a lot of your Black Thursdays or what have you have occurred in October. Not all of the crashes, but a healthy percentage of them. So a lot of people who are aware of that actually are a little nervous about October's. Okay. But September statistically is the worst month of the year. Not every year, but most of the years. What's the best month of the year statistically? It's very close. And I have to say that because certain things have hijacked the market over the past decade or so with quantitative easing and monetary and fiscal policy changes, it's interrupted things a little bit. But historically, April has edged out all other months just by a little bit to be the most bullish month of the year. Now let's get into periods. I think you'll find this interesting. The most bearish period of the year, historically speaking, not every year, understand, nothing's every year. The 3 worst months of the year, the pocket of the year that statistically is the most troublesome for the market, is August, September, October. Now that makes sense why September, being in the middle of that period, right, is the worst month of the entire year. So you've got your 3-month period, August, September, October, statistically being the worst pocket. September, in the middle of that pocket, is statistically the worst month. Now, this is going to be really interesting. What's the 3 most bullish months of the year? What's the most bullish period of the year? Well, immediately following the most bearish part of the year. So you have November, December. So you have really the latter part of October into November, December, and the beginning part of January. So it's really like that last week and a half of October, that last 2 weeks of October into maybe the first 2 weeks of January. That pocket of time is statistically extraordinarily bullish. In fact, it's so bullish, it has been so bullish that some people have called the market's rally during that period of time the Santa Claus rally. Now, there are many factors that lead into why August, September, October tend to be the worst months, and late October, November, December, early part of January tends to be the rebound months. And that's what's interesting. The worst period often is the precursor or the predecessor to the most bullish period. So that's not by mistake that the worst period of the year is first and what follows is the best period of the year. So these are interesting things to understand, and they can give you a small edge on certain things. If you are a day trader, then you have certain pockets during the day that are better than others. So generally speaking, the first 90 minutes of the day is the best part of the day. That is statistically speaking. Market has more flow, more liquidity, more controlled volatility. There tends to be more flow. And if you had only 90 minutes to trade short term, you'd really want to try to do it the first 90 minutes of the day. Of the first 90 minutes, the first hour is the best part of that first 90-minute period. It really depends on your style. Some people are not really good off the open like I am. Like that's my specialty, off the open. So it really depends. For me, that first hour is the most dynamic, and the first 20 minutes is above all. But it does depend on your style. But just understand that the first 90 minutes, the last 90 minutes comes in second. So you've got what I call the bookends, right? The first 90 minutes of the trading day, the last 90 minutes of the trading day. The first being the better one of the two. The second, the last 90 minutes coming in a close second. Now, what's the worst part of the day statistically for traders? What part of the day do traders tend to do the worst statistically, no matter what style or approach they are? The middle of the day, of course. And there are a lot of dynamics behind why that's the case. Okay, most traders that wind up doing well in the first 90 minutes, if they keep pressing very hard into the middle of the day, they will tend to undo all the good work they did in the first 90 minutes and actually go negative. So you want to be careful in the middle part of the day. The market kind of becomes lackluster. It loses a fairly hefty percentage of its participation. It takes on a different nature, a different characteristic. So what the mistake that a lot of traders make traditionally is that they experience the market's character in the first 90 minutes, and it automatically builds the assumption that that character is going to spill over into the middle part of the day and should continue, and that's usually not the case. The market has it has 5 in total, but 3 broad phases, if you will. First 90 minutes, middle of the day, last 90 minutes. And you want to really predominantly deal with the first 90 minutes, last 90 minutes. If you have to pick one, first 90 minutes. If you can do 2, first 90 minutes, last 90 minutes. Okay? All right, so that's interesting to know. Some people ask me about presidential election years, since in America, we're dealing with that right now. I've had questions regarding also what's better for the market. Is a Democratic controlled administration, is a Democratic demonstration better for the market statistically? Is a Republican and better for the markets? And in reality, traders, I don't like to wax philosophical with these things. I just look at facts. So I will tell you that while it's close, at the end of the day, it really doesn't matter very much who's in office. The market does what it's going to do for the most part. There is a tendency to overemphasize presidents and political parties. But if you look at history over a long period of time, markets have done well under all of them. Now, I will say this, that if you dig deep enough into the numbers, you'll find certain things interesting. Markets, most crashes in recent history have come under Republican controlled political scenarios in the States. So if you go all the way back, we can go back to President Nixon, we can go back to President Reagan. You know, you've got the crash of 1987. That's under President Reagan's, a Republican's reign. If we talk about the internet .com bubble burst in 2000, that's under President George Bush. If we speed forward a little bit and talk about the meltdown in 2008 that brought the American financial system, if not the financial system of the entire world, to its knees, 2008, that's also President Bush. If we talk about the 2020 Corona collapse, which brought the market down a little bit greater than 30% in a week, one of the most unprecedented market declines in history, that's under, obviously, President Trump. So when you talk about market crashes, then we have one party statistically to look at. If we talk about good market periods, then it's close. It's close. Although Democrats would have a slight edge. So you can go back in history. This is not a political statement. It's just, I'm a market player. I just look at facts. So we talk about the bottom of you talk about the mid 1990s, the bottom of the market in 1990, and the unprecedented run from 1990 to 2000 largely happened under Democratic rule, right? So not all of it, but the vast majority of that period is under Democratic rule. And at that time, it was unprecedented. If we talk about the bottom of the market after the collapse into 2008, we talk about the bottom of the market in 2009, all the way to basically now the vast majority of that market run from the bottom of 2009 is under Democratic rule. So it's still close when you go back far further and further and further. In recent history, the Democrats, as far as markets are concerned, Democrats trounce the Republicans as far as market performance. Trounce. There's zero, not even close. But if you go back over longer periods of time, it starts to even out. But in recent history, no. Now, I will say this about the political effect on markets. I will say this, that there's a tendency to overemphasize the short term and underemphasize the long term. At the end of the day, these anomalies do level out. So at the end of the day, it really doesn't matter. It really doesn't matter. Your life as a market player is not going to be that much better or worse no matter who's in office. So I'm speaking more specifically to my American traders. It won't matter very much. And in addition to that, we do want markets to go down at times. I mean, that's when we do perform the best, right? We make our money faster because markets fall harder and faster than they rise. It's a less challenging market when the market declines. So I don't know whether my American traders believe that the market's going to collapse if this person gets in and go up, if this person gets in. That's really not how you should be thinking. You should be prepared for no matter what the scenario is, okay? When we go up, have a plan if the market goes up. If we go down, have a plan for when the market goes down. You know, I've a long time ago stopped playing the political game. I don't care, to be very, very frank with you. I only care about being prepared for what scenarios the market can throw at me. So anyway, I thought that was interesting. I've been recently getting a lot of questions regarding what time of day is best to trade, what time of year is better than other years, is a presidential election year, does that have an effect on the market? Are we going to collapse after the election? Are we going to go up after the election? Is one party going to be better for the market than another party? And so since all of those questions have been coming in, I felt it was a good idea to sort of touch upon that today. All right. But listen, presidents come and go, but the market doesn't. Administrations come and go, but you don't, right? Don't forget that, right? Market's going to be around long after your favorite candidate is gone. Market's going to still be there, right? So don't major. My advice would be don't major in the minor things. Focus on just being ready and prepared for whatever scenario the market brings at you. Be a matcher. So if the market has 4 specific possibilities, all right, then have 4 game plans, and whichever one happens, just match the game plan. You got game plan A, B, C, D, right? All right. So if D happened, A, B, C, D. If D is the scenario, oh, boom, pull out D, apply it to the market. Oh, wait a minute. Scenario B is happening. I've got plan B for that. Boom. And that's how you basically deal with the geopolitical risk that a lot of people are sort of paying attention to now. But at the end of the day, it all evens out, guys. It really, at the end of the day, doesn't matter. I have been talking like this for years, especially during presidential years. Listen, again, a lot of people place too much importance on these things, largely because the news forces us to pay a lot of attention to it. But at the end of the day, guys, look, you're going to have the same children, no matter who gets elected in office the following morning. You're going to have the same house. You're going to live in the same area. You're going to have the same wife or husband, same obligations, same job if you happen to be employed. You're still going to be trading. You're going to have the same bills. You're going to have the same worries, the same wishes. You're going to want the same vacations. You're going to have the same dreams, the same desires. Nothing regarding all of those things are going to change. And if you're looking for someone to change those things, I believe you've got this whole thing wrong. No one's coming to save you. No one's coming to give you your dreams. You understand? No one's coming to give you the vacation you weren't able to have years and years and years, and all of a sudden you're going to be able to have a vacation. No one's going to give you the brand new house. No one's going to do that for you. So I just find that every time we get to these presidential election years, that a lot of people are just overemphasizing this idea that my life's going to dramatically change if this person's in office. It's going to be terrible if this person's in office. And truthfully, you're going to wake up the next day, no matter who's in office, with the same life you've always had. Right? Only you can change that. Right? I hope that doesn't offend anybody. It's not a political statement. That's what I teach my kids. That's the only thing I can teach you. You're my kids too. Goo goo gaga. You're my babies. Babies. All right. All right, guys. Cool. Great test. 105 people on Instagram. 249 people on YouTube. I've got 45 people on Twitter. All right. That's not bad. Never really. I don't know if is that Twitter directly or Periscope? Maybe it's Periscope. I don't know. We'll see. I had to turn TikTok and Twitch off because for some reason it didn't allow me to connect there. But Here we are, guys. Be on the lookout for more of this. All right. I just wanted to do a test. All right. Take the information I gave you, incorporate it into your market play, time of day, time of year. All right. I will leave you with this last thing. A lot of people are asking me, what do I feel about the overall market, where we are, what's next? Now, understand that nobody really knows what's next. And if someone tells you that they know what's next, don't believe them. All right. We can come up with probable scenarios. And I've done that fairly well throughout my career. But I will tell you this. It is somewhat amazing to me that uncertainty has not had an effect like it has historically has on this market. So the fiscal stimulus, and I don't even like to use that word stimulus, guys, because it is beyond being a stimulus. It's really not. It's actually, it's no longer a multiplier. When a government continues to use stimulus to give a shot in the arm to the economy, right? Each time you give the shot to the arm, it's like heroin. The effect is less. You know how drug addicts say that they're always chasing their first high, that the first shot is never is the wow, and then the ones after aren't really ever on the level of the first one. I mean, I don't know. This is what I'm told, all right? But it's like that first shot in the arm is incredible. And then each one, the effect gets less and less. It's almost like the body gets used to it and needs a heavier dose to have some effect. Well, it's the same. Stimulus from fiscal and monetary policy is like heroin. And so when you inject it more than once, the effect gets less and less. So it used to be a divider, right? Stimulus used to have a multiplier, which means that if for every $1 of stimulus that was printed digitally by the Federal Reserve, that would have a multiplier effect through the economy. So $1 would produce like $3 of GDP, gross domestic product. So that was incredible. We print $1 and we get $3 for the economy. So there was this Keynesian multiplier effect, right? This is a Keynesian model, right? So each time though, okay, so then it went from 1 to 3 to 1 to 2. So in order to get it to 3, you had to pump more into the economy to get the same multiplier effect. So then when it stopped being 1 to 2, even it went to 1 to 1, you had to pump more to get the same effect. So each time the stimulus has to be bigger to have the economy say, okay, that was good. That was good. Did I do the drug thing correct? Is that how they do it? Is that how they do it? Yeah, baby. You know what I'm saying? So they need a bigger and bigger dose, right? So this is why deficits and these things have to become bigger and bigger and bigger, because the effect is less. Now it's a divider. So every dollar of stimulus now is like 70 cents. So it actually subtracts from the economy now. That's how bad things are. So, but anyway, because of the flooding of fiscal stimulus, right? Since we got that out of the way, I think that has overshadowed the negative effects of uncertainty. So the market hasn't responded as it traditionally does to uncertainty, because stimulus has offset the negative power of uncertainty. Markets do not like uncertainty. Okay? Now, So despite a tremendous amount of uncertainty, how can you not have a tremendous amount of uncertainty during the greatest pandemic that's hit planet Earth in centuries? So of course there's uncertainty. We don't know if there's another wave. We don't know if there have to be other shutdowns. We don't know what the effect of things are next year for companies. We don't know who's going to be the next president of the United States. We don't know whether or not there's going to be another stimulus package and how big it is, or whether, this industry is going to be bailed out. There's so much uncertainty, yet the market is ignoring it because of the shots being put into the economy. That drug is strong. Now, here's my theory. I said all of that. I know it's a long time. I went all around this topic to come to this one point before I let you go. People have been asking me, what's my theory? What's my view? Well, okay. The market, you have to always look at the opposite. So if the market, for whatever reason, has stopped responding to uncertainty, since the market has been ignoring the highest level of uncertainty that we've had in a long time, then what's going to happen when uncertainty disappears? Think about it, traders. In this game, you have to always think the opposite. So right now, we have uncertainty up the wazoo, and the market is ignoring it. Well, what happens by going up? What happens when uncertainty stops and certainty reemerges? Then stimulus stops. So now you don't have uncertainty anymore. We know who the next president is. The last stimulus is done, no more of that. You understand? So always think on the other side of what the scenario is now. I believe, and we've been planning for this. I believe that once certainty returns, market's going to have some big problems. Huge. And there's a way to freaking take advantage of that. All right? We don't have to get into the arguments of whose fault it's going to be or whatever. Let the people on television do that. We focus on how do we feed our families from this? How do we benefit our children with this? How do we secure our future with this? How do we make money from this? All right? And so when is certainty going to start reemerging? In November. November onward. And so think about this. Markets tend to discount 6 to 8 months into the future. Do you understand this? Do you understand what I mean by discount? The market is a discounting mechanism. The stock market is a fairly decent, it's not perfect, but it's a decent discounting mechanism, which means that its reality today is reflecting 6 to 8 months into the future. So when you see prices today for a company like Facebook, as an example, it is predicting its state 6 to 8 months into the future. It is not now. That price is reflecting the view 6 to 8 months from now. Gold is longer. It too is a discounting mechanism. It is reflecting, right? It's reflecting 12 to 18 months from now. All right? So those are two things I want you to keep in mind, because we're going to talk a lot about that. Those two things can help you read the possible future better than most out there. And we're going to delve into that. I'm going to teach you how to bring those two things together in your overall analysis to at least be close most of the time. It'll help you prepare when these major turns happen and how to milk them for maximum profitability. All right, guys, not a lot of people in this industry talk to you like this. All right, guys. Enjoy the rest of your night. My traders, your contest has been kicked off. Do your thing. You've got until next Friday. I'm looking forward to those. And post them early. I'd like to share them on my social media networks. Put those stories out there of your IFT Trader Pro platforms. I'm very, very, very excited about this. I'm very interested in seeing those for you. All right, guys, enjoy the rest of your night. I'm going to actually catch a movie late, but maybe I'll see you live tomorrow. All right, guys. Ciao for now. Boom. I like this. I like it. I don't know if this is, I like it. Yeah. Whoo. I see you. My traders will understand. Bye-bye, Fusion. Bye-bye. Hello, IFT Trader Pro. Yeah. Love it. Love you guys.